A company just reported 45% revenue growth on nearly $30 billion in annual revenue. Growth accelerated, e-commerce accelerated, fintech accelerated, advertising accelerated, credit quality improved, and the stock fell 8%. Welcome to this market. Today we're breaking down the latest earnings from Mercado Libre, and more importantly, whether the market just handed long-term investors an opportunity. Because when I see fundamentals at all-time highs and the stock in a 30% correction, I pay attention. Let's go step by step. First, the headline numbers. Revenue came in at $8.8 billion for the quarter. That's 45% year-over-year growth, not 15%, not 25%, 45%. Operating income was $889 million. Net income was $560 million. Total payment volume hit $83.7 billion, up 42%. Gross merchandise volume hit nearly $20 billion, up 37%. And here's the key, growth accelerated at scale. This company is not small anymore. They're doing nearly $30 billion annually, and growth is speeding up. That is extremely rare. So why did the stock drop? Margins compressed. Operating margin declined about 450 basis points year over year. Why? Because management deliberately invested in lowering free shipping thresholds, expanding first-party commerce, growing cross-border logistics, scaling the credit card business. In plain English, they chose growth over short-term margin optimization, and Wall Street hates that. Now let's talk about what actually happened inside the business. Lowering free shipping thresholds in Brazil drove higher retention, more categories per buyer, higher purchase frequency, acceleration in items sold. Items sold grew 43%, accelerating versus prior periods, and fewer than 1/3 of Brazilian adults even purchased on the platform last quarter. The runway is enormous. Now, logistics. They absorbed 41% more shipment volume, nearly 500 million additional shipments, and unit shipping costs fell 11% in Brazil. That is scale efficiency in action. They're shipping more at lower per unit cost while improving service levels. That strengthens the moat. Advertising revenue grew 67%. This is high margin on top of growing marketplace. More traffic, sellers, and ad monetization. That machine is spinning faster. Now, let's move to what might be the most important segment, Fintech. Assets under management grew from $2 billion to nearly $19 billion in 3 years. Monthly active users more than doubled to 78 million. The credit portfolio grew 90% year over year to $12.5 billion. And here's what matters. Non-performing loans declined to 4.4%. They're scaling credit while improving asset quality. That's not easy. Less than 20% of Mexicans have a credit card. Only 40% of Argentinians. This is financial infrastructure being built in real time, and Mercado Libre sits at the center of it. Now, here's a sentence that explains everything. We do not solve for short-term margin optimization. They explicitly stated that strategic investments reduced operating margin by 5 to 6 percentage points in the quarter. That was intentional. They are building dominance, not quarter-to-quarter optics. Let's zoom out. Every major region, Brazil, Mexico, other countries showed accelerating revenue growth. Commerce revenue up 40%, fintech revenue up 51%, gross profit up 43%, Brazil commerce up 41%, Mexico commerce up 51%, fintech in Mexico up 64%. Acceleration everywhere except Argentina. This was not a weak quarter. This was an aggressive investment quarter. Big difference. Now let's talk valuation. Market cap, roughly $88 billion. Adjusted free cash flow reported, $1.5 billion, but that includes heavy reinvestment into the credit portfolio. If you adjust for growth, CapEx, exclude debt proceeds, you get roughly $6.2 billion in underlying free cash flow potential. That implies the stock trades around 14 times free cash flow potential for a company growing revenue 45%. Historically, the stock has traded closer to 15 to 18 times gross profit. Today, it's around 7 times gross profit. You have to go back to 2009 levels to see similar multiples. Now let's be conservative. Assume 15% free cash flow growth for 5 years, 20 times terminal multiple that implies roughly 23% annualized returns. And frankly, 15% growth looks conservative given current acceleration. Here's what I think is happening. Short-term investors are focused on margin compression, EPS misses relative to analyst estimates, quarter-to-quarter optics. Long-term investors should be focused on market share gains, ecosystem flywheel strength, scale economics improving, structural growth runway. Mercado Libre is building the dominant e-commerce network, the dominant fintech ecosystem, an expanding advertising engine, a logistics backbone across Latin America. This is not financial engineering. This is infrastructure creation. Are there risks? Of course. Credit expansion always carries risk. Latin American macro volatility is real. Argentina remains unstable, but the data right now shows growth with improving efficiency. That combination is rare. So when I see accelerating top-line growth, expanding user engagement, strengthening ecosystem flywheels, margin pressure caused by strategic reinvestment, and a 30% stock correction, I don't panic. I get interested. Personally, I am buying into this weakness. If the stock stays depressed, I'll continue accumulating because I believe the intrinsic value of this business is growing faster than the share price reflects. And over long periods, price follows fundamentals, not emotion. That's my breakdown of Mercado Libre's earnings. If you appreciate deep, fundamentals first analysis, not hype, not noise, subscribe to Smart Wealth Code. We focus on businesses, we focus on cash flow, we focus on long-term compounding, and when the market gives us disconnects like this, we pay attention. I'll see you in the next one.